I want to move on and to another subject that's of great interest to the listeners, and that's inflation and how to deal with it. And Ed, I'm going to turn to you again. I know you get a lot of questions on this topic at American Century. The two questions I get all the time now, the two biggest questions, it's not about stocks. It's one, how do you protect against inflation? And second, how do you get a higher yield with as little risk as possible? Tell me what you're telling clients about. Let's just take the first topic, protecting against inflation. There's ETFs out there. Vanguard's got an inflation-protected securities, for example. How do you answer that particular question for clients?
So there's a couple of ways, and I'll keep it short. But you can always go with shorter-term inflation-protected securities, as an example. When you do that, you eliminate the potential credit risk that longer-term inflation-protected securities have. They tend to focus more on yield than inflation. The other thing you can do is increase your yield in your portfolio. And I'll give you just a short example. On the growth side of the equation, right, instead of owning pure growth securities, you could look at it another way and own convertible securities. And when you own convertible securities, you get a little bit of a higher yield. Granted, it's not that high. And in addition, you also tend to get a little less volatility as rates start to rise or as inflation comes into play. It's the same impact with when you look at fixed income. Right, you want to go into, if you're going to worry about inflation and you're in fixed income securities, you know rates are going to start to go up as an impact of that, and the markets are going to get volatile on the equity side. So you want to shorten the duration. And as you shorten the duration, that's one way you can do it, because as rates rise, you'll get hurt less. The second aspect is, the other thing we talk about is being active. Looking for a portfolio where an active manager owns it and can run it. And that way, if an active manager is running it, he or she can turn the portfolio over faster to take advantage of things that come up in an inflation environment. Where bonds may have fallen in value, they can add it to the portfolio faster and create a higher yield within that portfolio over time.
That's a very good example of where I could see active management would have a real advantage over passive management. Tom, I want to move on to the second question. This is the other big question. Getting a higher yield with as low risk as possible. Now, I know some people are interested in preferred securities. I get a lot of questions about this. Some of these preferred ETFs are getting 4%, even 5%, I've seen, or higher yield. Are preferred securities, preferred ETFs attractive now? And what, if any, are the risks to owning those higher yielding?
Yeah, Bob, I mean, after 30 years of declining rates, advisors, investors are having to act harder. They're having to work harder. Active, as Ed said, is where a lot of the money's going. Advisors are doing a couple of things. Either they're going to cash or they're looking for alternative strategies for income, and preferred's a great way. I mean, in the financial markets, there's a great advantage in rising interest rates because banks tend to do better because they lend out money at higher rates, so it's more profitable. So you're going to see more there. American Century's got an active strategy in QPFF. We know iShares has PFF, and then First Trust, also one of the big ones, FPE. They've done some great jobs there. But I would tell you what Ed is saying about active is really going to be key and critical. And since they're offering these types of strategies just recently, and they tend to be smaller, you're getting some of their best ideas. We've had a lot of conversations with the folks at American Century, and advisors are coming in as opposed to going with the major market indexes, because not all constituents in these fixed income indexes are created equal.
Yeah. And what I just want to remind everybody, it's good, Tom, to remind everybody exactly what goes on in preferred. Number one, generally higher yield than common. Number two, no voting rights. Important feature there, and that's a very important feature. And number three, they have a preference in the queue over common shares in terms of if the company goes bankrupt, preferred shares will get paid out before the common shares are ahead of the queue. And those are some of the obvious advantages right now, Tom. Now, Ed, then there are those, I don't know what you call them. I think core plus ETFs is what you said in the past. I think that's probably the right way to describe them. They add a bit of a high yield to a simple core bond fund like AGG, the big bond fund. They add bank loans. They add mortgages. I know American Century just started a multi-sector income ETF. MUSI is the symbol for that. Tell us about it.
Yeah, so Tom, it's designed to move with the markets in a sense. So it's searching for a higher yield. So you're going to invest in investment grade, high yield, as well as bank loans, potentially even emerging market debt, where the portfolio manager sees they can add value to the portfolio, keep the duration. In this case, we try to keep it a little bit shorter right now because obviously we've been in this lower for longer environment, potentially going up. In addition, it offers a bit of a higher yield because of this. And so people have gravitated towards that because of the higher yield. It's grown a little bit, so the dividend has been muted to a degree. It's been around 3%, but usually it's a little bit closer and a little bit higher than that. But in this type of environment, gravitating towards yield has been what clients are looking for. And the way this product can move around, or any of the Core Plus products, truthfully, is because a lot of them are active, they can shift and move to where there's more yield, and they can also be a little bit shorter in duration. And by doing that, it covers sort of both topics in the search for yield, and also if you're worried about inflation, you're keeping that shorter duration, and you're taking advantage of both. Plus, it's what we mentioned earlier on the active side. We have somebody who's very highly invested in this, watching it from the portfolio manager every day, and they're actively looking for advantages in that. And I think in that space overall, Bob, it really can be advantageous to have it in the portfolio, especially as we've been in, as Tom said, rates have been falling forever, basically, it feels like.
Yeah, and yet, Tom, we know there's risks here, right? I mean, remember, we had money market funds that tried to add a little juice in 2006 and 7.
No, you're right.
They threw in some short-term corporates. So, it's nice to say, oh, yeah, I want a little more yield over here. But you are taking risk, right?
You're absolutely taking risk. And we're seeing more and more advisors, Bob, we survey them all the time, that are moving away from 60-40 because they don't feel like they're going to get that true return in the 40, and they're moving to 70-30 and even 80-20. And when you do that, and you actually have more exposure on the equity side, even though you're chasing yield, but boy, we haven't had a major correction in a long period of time, aside from the blip that we had last March. These are one of those things to consider. I think other strategies that we're seeing in ETFs, these covered call strategies that are providing some great yield, ETFs like GEPI, GEPI, and NUSI, NUSI, and QYLD, a 7+% yield where you're also getting a equity exposure. This is something that can replace current equities exposure and also give you that yield you're looking for as well. So the ETF industry continues to expand and provide more options as people are chasing yield these days.
And Ed, remember, I'd be remiss if I didn't mention the big kahuna in this space, the actively managed bond fund, Jeff Gundlach's fund, TOTL. He's doing very well. I think he's pulling north of 2% yields right now, right?
Yeah, he is. And that's, again, that goes back to that Core Plus view or anything. If you alter just the basic ag, right, which has a lot of treasury exposure, which isn't paying much, and you can shift that around without adding much risk to the portfolio, or really, if you're taking risk, getting rewarded for it with a higher yield, it really makes sense in the fixed income space. Because if, thinking on what Tom said, advisors shifting away from the 60-40 to go 80-20, or even abandoning fixed income altogether, which some have told me, creates significantly more risk in a market that hasn't seen a significant pullback that's extended. We had one last March, but it didn't extend for a long period of time. And is it better to get some yield out of fixed income if you can search for that yield, whether it's the product you mentioned or some of the others we've talked about, either preferreds or even some of the covered call, and really get some fixed income exposure back in there that can really offer a benefit to a portfolio, especially if we pull back.
Yeah, this is really where the active management, I think, really pays for itself at this point.